Fueling Growth, a guide to working capital solutions for small businesses. By avibusinesssolutions.com. A cash crunch rarely shows up at a convenient time. It hits when payroll is due, inventory needs to be restocked, a large client pays late, or a seasonal opportunity shows up faster than expected. That is why understanding working capital loan options matters for small business owners who need speed, flexibility, and a funding solution that actually fits the way their business runs. Not every business needs the same type of capital, and not every funding product solves the same problem. Some options are designed for short-term cash flow gaps. Others work better for ongoing access to funds or for businesses with uneven revenue. The right move usually comes down to how quickly you need money, how often you expect to borrow, and your current repayment capacity. What working capital loan options are meant to cover. Working capital financing is designed for day-to-day operating needs, not major long-term expansion projects. That usually means payroll, rent, marketing, inventory, repairs, utilities, supplier payments, and other routine expenses that keep the business moving. This distinction matters because lenders often evaluate working capital requests differently from equipment financing or commercial real estate loans. They are looking closely at revenue consistency, time in business, cash flow strength, and how quickly the business can repay the advance or loan. If you need funds for a short-term operating need, a faster, more flexible product often makes more sense than a traditional loan with a long approval timeline. The main working capital loan options to consider. Business line of credit. A business line of credit is one of the most flexible options available. Instead of receiving one lump sum, you get access to a credit limit and draw funds only when needed. You pay for what you use, and once repaid, the funds may become available again. This works well for businesses with recurring cash flow gaps, seasonal patterns, or unpredictable expenses. A restaurant dealing with equipment repairs, a retailer preparing for holiday inventory, or a contractor covering material costs before customer payment can all benefit from that flexibility. The trade-off is that stronger qualifications often lead to better rates and terms. Some lenders also charge maintenance fees, draw fees, or require periodic reviews. Is a practical option, but only if the total cost and access terms are clear up front. Short-term business loan. A short-term loan gives you a lump sum of capital with a fixed repayment schedule, often over a few months to 2 years. This is a common choice when you know exactly how much you need and what will be used for. For example, if you need $30,000 to cover payroll and supplier invoices during a temporary slowdown, a short-term loan can offer quick access and predictable payments. Many small business owners like the simplicity. There is a clear borrowing amount, a set payoff period, and a direct path from funding to use. The caution point is repayment pressure. Short-term loans can come with higher effective borrowing costs than longer-term financing, and weekly or daily payments can strain cash flow if revenue is uneven. Speed is valuable, but only if the payment schedule matches your business reality. Merchant cash advance. A merchant cash advance is not a traditional loan, but it is often included among working capital loan options because it can provide fast funding based on future sales. The provider advances capital and collects repayment through a percentage of daily card sales or fixed daily withdrawals. This can be appealing for businesses that process a high volume of card transactions and need funding quickly, especially if they do not qualify for more conventional products. Approval is often based more on revenue performance than on credit alone. Still, this is usually one of the more expensive forms of financing. It can help in a true short-term need, but it should be approached carefully. If margins are already tight, daily repayments can quickly reduce breathing room. Invoice financing or invoice factoring. If your business regularly sends invoices and waits 30, 60, or 90 days to get paid, invoice-based financing may be worth considering. With invoice financing, you borrow against unpaid invoices. With factoring, you sell those invoices to a third party at a discount. This is often useful for B2B companies, staffing firms, transportation businesses, and service providers with reliable customers but delayed receivables. It turns outstanding invoices into faster access to cash. The benefit is that the funding is tied to assets you already have in motion. The downside is cost, and in some factoring arrangements, customer interaction can be affected because the factor may collect payments directly. It works best when slow receivables are the main bottleneck. SBA working capital financing. For businesses that can qualify and can wait a bit longer, SBA-backed financing may offer attractive terms. These loans can be used for working capital and often offer lower rates and longer repayment terms than many fast funding products. This route can be a smart fit for established businesses with solid documentation and time to go through the process. The lower cost can make a big difference over the life of a loan. The challenge is speed and paperwork. If payroll is due Friday, SBA financing may not solve the immediate problem, but for planned working capital needs is worth evaluating. How to choose between working capital loan options. The best funding choice depends less on the product name and more on the problem you are solving. If your need is ongoing and unpredictable, a line of credit often makes more sense than a fixed loan. If you have a one-time shortfall with a clear amount, a short-term loan may be cleaner. If unpaid invoices are creating the squeeze, invoice financing may be the most logical fit. It also helps to look beyond approval speed. Fast funding is valuable, but total repayment cost, payment frequency, prepayment terms, and fees matter just as much. A low-friction application means very little if the repayment structure creates a bigger problem a month later. Ask a few practical questions before moving forward. How quickly do you need the funds? Will the financing generate revenue, preserve operations, or patch a recurring issue? Can the business comfortably handle daily, weekly, or monthly payments? Are you borrowing to cover a temporary gap, or is it a cycle that repeats throughout the year? Those answers will usually quickly narrow the field. What lenders typically look for. Most providers review revenue, time in business, average bank balances, and recent cash flow trends. Some place more weight on personal credit than others. Fast access lenders may be more flexible on credit if the business shows consistent deposits and healthy sales volume. This is why preparation matters. Clean bank statements, current financial records, and a clear explanation of fund use can improve your options. The stronger your documentation, the easier it is to compare offers based on value instead of settling for the first approval. If your business is newer or your credit profile is less than ideal, that does not always mean financing is out of reach. It may mean the structure, cost, or borrowing amount looks different. A solution-oriented provider like AVI Business Solutions can help connect business owners with funding paths that align with urgency, business profile, and repayment capacity, rather than pushing a one-size-fits-all product. Common mistakes to avoid. One mistake is borrowing too little and having to return for more capital almost immediately. Another is borrowing too much and carrying unnecessary repayment weight. Both can put pressure on operations. A more costly mistake is choosing based only on approval speed. The fastest offer isn't always the smartest. Daily repayments, stack financing, and unclear fee structures can create long-term strain from short-term decisions. It is also risky to use working capital for expenses that should be financed differently. If you are buying a long-life asset, short-term capital may not be the right tool. Match the financing term to the life of the need whenever possible. When the right funding creates real momentum, the best working capital financing does more than cover a gap. It helps you stay on schedule, protect vendor relationships, capture sales opportunities, and keep customers served without disruption. In a small business, timing matters almost as much as cost. That is why working capital loan options should be viewed as tools, not just products. Used well, they can smooth cash flow, support growth, and give you room to operate with confidence. The key is choosing funding that fits your business as it actually performs, not as a lender wishes it looked on paper. If you need capital, move with urgency, not guesswork. The right option should give your business more control, not less.
Running a small business means being ready for anything. But what happens when the big banks say no? At AVI Business Solutions, we say yes.